Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three top-ranked tech stocks to consider buying as we start a brand new month of February. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look at some of our services, portfolios, and more. So we're going to start before we look at these three highly ranked tech stocks to consider buying. Just a broader picture of the market to give a better sense of the context of why it might be a good time to consider buying some of these stocks. So the market went on a pretty wild ride during the last week of January. Last week started with the S&P 500 and the Nasdaq jumping to new records. Stocks then tumbled on Wednesday in a move that was fueled by profit taking and investors in Wall Street really trying to digest and figure out what was going on with the pretty public and major short squeezes over at GameStop and elsewhere. So all three major U.S. indexes then fell almost 2% to end the week on a low note. So end trading in January pretty down, with the benchmark index then close to where it began 2021. So a wild month of January to start the new year. That said, the recent pullback is likely pretty healthy for a market that had soared since early November on vaccine positivity and hope that there would be more coronavirus stimulus under the new Biden administration. So then, as we, at this point, probably know, stocks jumped back to start the first week of trading on February, with the Nasdaq up about 2.4% through morning trading on Monday. The climbs came on the back of big gains from Skyworks Solutions, Tesla, Microsoft, Google, and some other big names. So overall, the outlook appears pretty strong going forward, even though the winter has been pretty rough amid some increased coronavirus lockdown restrictions and measures. And we saw consumer spending dip about 0.2% in December, which was its second monthly decline. And then we also saw last week the official U.S. GDP data come in for 2020, and that saw U.S. GDP growth sunk by 3.5% last year. And obviously, going forward, we're expecting much better things in 2021. So the U.S. economy is projected to decline by nearly 4%. There's obviously different projections from different groups out there. The CBO just put out their economic outlook recently. U.S. also, as we mentioned, U.S. household spending, or alluded to, they've been saving a lot during the pandemic, so there will be certainly a ton of pent-up demand if and when things return closer to normal, hopefully by the summer or later summer. And then we're going to take a look at the broader earnings picture, which has continued to improve. We saw some big blowout results last week from some of the biggest names in the market that were kind of clouded out by what was happening with GameStop and some other stocks. So looking ahead to the broader annual outlook. So for 2020, we're calling for overall S&P 500 earnings to decline about 16.4% on about 2.2% lower revenue. And then if we look ahead to the current year, so 2021, we're expecting the overall S&P 500 earnings to jump over 25% on nearly 8% higher revenue. So a big comeback is expected this year. We also saw the Fed last week commit to keeping its interest rate near zero. And as we mentioned, that improved earnings outlook sets up what should be a pretty bullish case for 2021. And as we also mentioned, some of the strong earnings results last week were crowded out by GameStop and AMC. So it's probably sets up a better view of some of these tech stocks who actually fell after reporting strong results last week. So that brings us to today's topic, which is top-ranked stocks from the broader technology sector that might be worth buying right now. And we're going to start with Micron, which trades under the ticker MU. It is the one of the largest makers of memory chips in the world, and it has roared back over the last 6 months within the pretty historically cyclical space. So the memory chip firm returned to growth in Q3 with its sales up about 14%, and then its fourth quarter revenue climbed 24%. And then most recently, MU topped our first quarter FY21 estimates on January 7th, and it provided some pretty strong guidance. So overall, Micron looks to benefit going forward from strong demand in 5G, cloud computing, the automotive industry, and elsewhere. So the stock has surged about 60% in the past 3 months after it began to break out of a rough stretch in August of 2020. Its shares are up way more than that over the last 5 years. This includes some lulls for, as we mentioned, that historically cyclical stock. So the stock's up about 620% in the last 5 years. That more than doubles the semiconductor industry's average, and it might be poised to keep on climbing given its outlook. And Micron's, with that said, its valuation is a bit stretched in terms of where it has traded historically. But with that in mind, the memory chip space is treated more like a commodity within the semiconductor industry, so it still trades at a pretty solid discount to its overall industry. We should also note that 14 of the 21 brokerage recommendations that Zacks has for Micron come in at a strong buy right now, with 3 more at a buy. Looking ahead, our estimates are calling for Micron's fiscal 2021 sales, so the current year, to jump 16%, with FY 2022 then projected to climb another 25% higher, up above 31 billion. And then on the bottom end of the income statement, MU's adjusted earnings are projected to surge 36% this year, and then a mind-blowing 98% in 2022. And then we've also seen the company regain some huge momentum on the bottom line. So analysts have raced to up their earnings outlooks since that strong report in early January. And this helps the stock grab a Zacks ranked #1 strong buy. Right now, investors might also be pleased to know that the stock is sitting off its recent highs. It was trading at around $80 per share, and it's up again this morning on Monday morning after having some movement last week as well. And now we're going to transition on to one of the biggest names in the world, in certainly the investing world, and that is Apple, who had blowout quarterly results last week that, as I've said a couple times now, were definitely outshined by all of the craziness going on with GameStop and some other stops. So obviously suggesting a company like Apple is pretty straightforward, but that doesn't make it really any less valid. The iPhone giant topped its Q1 FY 2021 earnings estimates by 20% last week, and then its sales grew by 21% to $111 billion, which came in 8% above our estimate. So they crushed both the top and bottom lines last week. So overall, the ability for this high-end consumer products company to post this kind of growth during a global pandemic that's highlighted by obviously economic hardships in various sectors is part of the reason why it's one of the world's most valuable companies and one of the world's most valuable brands. So Apple's latest and its first 5G capable iPhone that launched in October, which is that iPhone 12, got off to a pretty great start, with iPhone revenue up 17% in the period to account for about 60% of total sales. So despite all of its growth in other areas, that iPhone is still a very large chunk of its business, especially during these release-based periods. The remote work world has also continued to boost iPad and Mac sales that were up 42% and 23% respectively last quarter, so some big growth there. And then meanwhile, its Apple Watch and its AirPods heavy wearable unit was up about 30%, while its services business was up nearly 25%. So the company now boasts over 620 million paid subscriptions, which is up 140 million from last year. And this is as they try to keep on growing and generating more and more money from its growing device basis. So it's good to see them get that subscription count up. And this is obviously some App Store and Apple Music is that services business. It's Netflix competitor, which is that Apple TV Plus. So they're going to continue to roll out various services, the video gaming, everything under the sun. And that's Apple's plan, is just to keep on growing its services business. Apple is also working, as we should mention, to design more of its chips in-house, and it plans to introduce more privacy features on the iPhone, as it kind of has a pretty public spat with Facebook and some others. So it'll be interesting to watch what goes on the privacy front, as that could be the next big marketing push for Apple, is to say that we're gonna let you maybe hide some of your user data from some of these apps. And they, as I mentioned, it's worth watching Facebook and Apple trade some attacks on each other. If investors aren't impressed enough with all of those continued growth opportunities, in a world where people are addicted and glued to their smartphones and devices, the company boasted $84 billion in net cash. And this is going to help them continue to buy back stock and continue to pay dividends. And they are on a mission to reach a cash neutral position over time. So they're just going to continue to spend and spend and spend, and they continue to buy back their stock, which is great for all of the Apple shareholders out there and potential Apple shareholders. So with this in mind, Apple's Q2 sales are now projected to surge over 30% to help lift its adjusted earnings by 55%, with this estimate marking its strongest revenue growth since 2015. And Apple's post-release revisions have helped it land a Zacks rank #1 strong buy at the moment. With that said, Apple has fallen since hitting new highs on January 25th. The stock is up about 70% in the last year to top the tech sector's 40% climb. As we mentioned, it got run up to new highs and then it sold off after earnings, and it's up again on Monday. So certainly worth, if you're a longer term investor, buying Apple below its recent highs is not necessarily it's pretty straightforward seemingly. And despite that, it's also trading about relatively in line with the broader technology sector at about 33 times forward earnings versus that 28 times forward earnings average. So despite that massive run for Apple and it being one of the biggest companies in the world, its valuation is not that stretched compared to the broader technology sector. And then obviously you get that dividend payment we mentioned as well. And it can't be stressed enough that their quarter sort of got overshadowed by everything that was happening with GameStop, and it's worth diving into just how impressive Apple's quarter was. And you could certainly see them going on a nice run in 2021. And now we're going to close with another Zacks ranked #1 strong buy tech stock, and that is Shopify, which trades under the ticker SHOP. Pretty straightforward there. So it was one of the stars of the market when it surged off its lows last March, which now we're approaching we're getting closer and closer to that 1 year anniversary of the big market coronavirus crash, and then the following a massive comeback. So that was a winner, along with Zoom and many others who benefited from those coronavirus conditions. The stock soared nearly 200% since those March lows, but a majority of those gains came early on. So in fact, the e-commerce firm has underperformed the tech sector and the S&P 500 during the last 6 months, up just around 6% as we get closer and closer to its Q4 release that is due out on February 17th. So overall, digital commerce is going to be growing for years and years and years, and the pandemic helped spur the broader adoption among businesses that might have been holding out. So this massive expansion on the e-commerce front is going to benefit everyone from FedEx and Amazon, who continues to gobble up more and more market share. This is also seeing everyone from Target and small mom and pop shops rolling out more and more e-commerce options, because it's really one of the ways to grow in that retail space, and it's going to be for years and years to come. As we mentioned, and despite all of the talk and all of the story about how big e-commerce is and how much it grew during the coronavirus, e-commerce accounted for only 14% of total US retail sales in the third quarter, down from a record of 16% in the second quarter. And it's worth pointing out, obviously, this was up big from the year ago period when it accounted for about 11%. But given all the buzz and the absolute perfect conditions to dominate with people trying to stay at home, it still accounted for far less than 20% of total domestic retail sales, which gives digital commerce focused companies plenty of runway going forward. Shopify if you don't know Shopify's business, they help companies adapt to e-commerce. So they claim to help power more than 1 million e-commerce businesses. They help build, maintain, and grow their e-commerce presence. They make money from recurring subscription fees and add-ons. So the company currently offers different tiers, one that's aimed at entrepreneurs as well as small and medium-sized business, and another that's geared towards those higher volume merchants and larger businesses. The Canadian company's most basic package starts with a monthly fee of about $29 for sellers and a 2.9% transaction fee. Shopify also has continued to partner with heavyweights of both retail and tech. So this includes Walmart and Facebook. It's also worth noting that the company was on a really, really impressive run long before the coronavirus. So this is not just a one-time, one-hit wonder of, oh, this is a e-commerce stock, let's run it up as e-commerce grows in prominence during the coronavirus. So Shop surged from under $30 a share back in 2016 to over $500 in January of last year, so before the coronavirus crash. And Shopify sales helped support that move, with 2019's sales up 50%. And that was actually its slowest growth since it went public back in 2015. Shop then posted nearly 100% revenue growth in both Q2 and Q3, with its monthly recurring revenue up about 50% last quarter. Some of the most recent information we have, which is going to be indicative to might be what happens in their fourth quarter, is that their Black Friday / Cyber Monday weekend sales were up 80% in 2020. So with this as a backdrop, our estimates are calling for its fourth quarter revenue to jump 80% to over $900 million, with its adjusted earnings projected to climb about 190% all the way to $1.24 per share. And then if we look as a whole, its revenue is projected to climb 81% this year to about $2.9 billion, with its earnings per share expected to climb from 30 cents in the year ago period all the way to $3.74 per share. This sales growth would beat the last 3 years. So as we mentioned, it did about 50% growth last year. It did about 60% growth in 2019 and 73% growth in 2018. So we're calling for 81% top line expansion. And then if we look ahead to 2021, its revenue is expected to climb another 30%, or about $860 million above our 2020 estimates. So they're going to continue to grow. And then, like with all these stocks, its positive bottom line revisions help it grab a Zacks rank number one, a strong buy at the moment, as we mentioned. And it's worth mentioning again, since both of these other companies have already reported their results. They report on the 17th of February. And the positivity from companies like Apple and Microsoft and other big names in tech and in the S&P 500 in general could spell some positive news for the e-commerce firm. Shop sits currently about 10% off its 52-week highs, which help make it a little bit more enticing for those who are thinking about buying Shop. That said, it still does trade at a solid premium compared to Amazon and Etsy, but it is a growth-minded stock for people who are trying to add growth to their portfolio, and longer-term investors might want to consider Shopify, since its business caters to businesses big and small who must grow online in order to thrive for years and years to come. And those growth figures we talked about for Shopify certainly are pretty impressive. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute, an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.